Welcome back to this special deep dive episode of the Daily Crypto Roundup, where we take one big story that's shaping the entire market and pull it apart properly. No 10-second sound bites, no surface-level headlines, just a full breakdown of what's happening, why it matters, and what comes next for anyone holding Bitcoin, Ethereum, Solana, or any altcoin in between. And today's episode is all about one thing: the Fed Crossroads. Because right now, everything in crypto is orbiting around a single event on the calendar. The Federal Reserve's December meeting on the 9th and 10th, where they'll decide whether to cut interest rates again, hold steady, or surprise the market completely. That decision won't just move bonds or stocks. It could reshape the entire crypto landscape overnight. Over the last few weeks, we've seen exactly how sensitive crypto is to macro conditions. Bitcoin has taken heavy hits, the broader crypto market has shed hundreds of billions in value, and every bounce has felt weaker than the last. But behind the charts and the liquidations, there's a bigger story playing out. The Fed has already started cutting rates this year, bringing the federal funds rate down into the mid-3 to 4% range, and now it's facing a brutal balancing act. On one side, there's a labor market that's clearly softening, households feeling the strain, and parts of the economy losing momentum. On the other, inflation is still above that 2% target, inequality is widening, and some Fed officials are worried that cutting too fast could reignite price pressures. That's the crossroads, and crypto sits right in the middle of it. Before we go any deeper, just a quick note and a genuine thank you. We've seen a wave of new 5-star ratings come in for the show recently, and it genuinely helps keep this thing growing and visible. As a little Christmas thank you, we're also running a giveaway. If we hit 200 ratings before Christmas, 2 listeners will get 50 XRP each. If you've already rated the show in the past, just scroll down and comment "Done" so we know to include you. It takes a couple of seconds, it keeps the podcast free for everyone, and it really does make a difference to how far these episodes travel. Now, let's set the stage. The Fed's December 9th and 10th meeting isn't happening in a vacuum. It comes after a year where they've already pivoted away from the peak rate regime that dominated 2023 and early 2024. We've gone from an environment where the Fed was holding rates above 4.5%, keeping financial conditions tight, to a world where they've now cut twice, bringing the policy rate down into a 3.75 to 4% range. That might not sound like much, but it's a clear signal. The tightening cycle has ended, and we are now in the early stages of an easing cycle. The problem is, the easing has been cautious. Every cut has come with a warning label. Officials keep reminding markets that inflation is still sticky, that the economy hasn't truly rolled over, and that they are prepared to pause again if needed. So instead of a clean pivot, we've got this stop-start, data-dependent, nervy drift toward lower rates. Inside the Fed, opinion is split. You've got people like Mary Daly at the San Francisco Fed, who supported the last cut and has said publicly she's open to another one in December if the data justifies it. She's looking at signs of a softening labor market, rising layoffs at the margin, and households clearly feeling the squeeze, and her view is that you don't wait until things break. On the other side, you've got voices like Susan Collins in Boston and Raphael Bostic in Atlanta who have been pushing back hard against another December cut. Their concern is simple. Inflation has been above target for years, and even if headline numbers have eased a bit, underlying price pressures haven't fully gone away. They worry that too many cuts, too quickly, could undo years of hard work in restoring credibility. And then you've got Chair Jay Powell in the middle, publicly non-committal, stressing that December is not a done deal either way. The bigger complication is that the Fed is flying partially blind. A government shutdown has delayed some of the official economic data they'd normally have in hand by now. And that means they're relying more on private surveys, anecdotal evidence from businesses, and incomplete labor indicators. For a central bank that loves its data, that's deeply uncomfortable. It makes them more cautious, more hesitant to commit to a path. And that caution is exactly what markets are struggling with. Because traders love certainty. They don't even need the decision to go their way. They just want a clear signal. Right now, they don't have one. So why does this matter so much for crypto? The simple answer is that crypto has matured into a macro asset. It behaves less like a fringe, uncorrelated weird kid at the edge of finance, and more like a high beta cousin of tech and growth stocks. When rates are high, liquidity is tight, and investors are nervous. Bitcoin trades like a leveraged risk asset. When rates fall, liquidity improves, and risk appetite returns. Bitcoin behaves like an accelerator for that shift. We've seen it time and time again around big macro events. During the COVID era, when the Fed cut rates to zero and flooded markets with liquidity, Bitcoin went from under 10,000 to over 60,000. During the inflation shock and tightening cycle, when the Fed jacked rates up rapidly, Bitcoin fell from 69,000 down into the teens. And this year, as the Fed has cautiously moved away from peak rates and opened the door to cuts, Bitcoin has staged significant rallies, but with huge fragility underneath. To understand why this December meeting is different, you have to look at where crypto sits structurally in late 2025. We've now got spot Bitcoin ETFs absorbing and releasing flows daily. We've got big institutional players using Bitcoin as part of macro portfolios, rather than as a pure speculative play. We've got companies holding crypto on their balance sheets, and we've got a derivatives market layered on top of all of that. When the Fed cuts, it doesn't just lower the abstract cost of money, it changes how all of those actors behave. Suddenly, borrowing to buy risk assets becomes more attractive. Discount rates on future earnings fall, which boosts tech stocks and, by correlation, crypto. Risk parity funds shift allocations. Relative return traders look for beta again. And crypto, sitting out at the far edge of the risk spectrum, gets swept up in that wave. But the flip side is just as important. If the Fed doesn't cut in December, or if Powell leans hard into a hawkish tone in the press conference, markets will treat that as a signal that tighter for longer is still the base case. That doesn't mean instant collapse, but it does mean risk assets could see another leg lower, or at best, drift sideways in a choppy, unpleasant range. For crypto, that could mean more of the same. Fragile rallies, sharp pullbacks, and no clean trend. Now, before we go any deeper into the mechanics, we're going to take a quick break for today's sponsor. Don't go anywhere.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
All right, let's get back into it. Now let's break down the three broad scenarios for December. The first is the cut scenario. In this version of events, the Fed sees enough evidence of labor softness, enough strain in lower-income households, and enough cooling in forward-looking indicators that they decide to deliver another 25 basis point cut. They frame it as a continuation of their insurance easing, not a panic cut, but a thoughtful adjustment to keep the recovery going without breaking the anti-inflation narrative. Markets, which already see a decent probability of a cut, would still react strongly, because a confirmation is different from a possibility. Stocks would likely rally, bond yields would edge lower, and crypto would probably catch a bid as traders position for a 2026 liquidity cycle. In that cut scenario, Bitcoin tends to behave in a very familiar way. You often see a short-term knee-jerk move, sometimes even a brief dip if the cut was fully priced in, and people sell the news. But in the days and weeks after, the structure shifts. ETF inflows tend to rise because lower yields make non-yielding assets more attractive. Marginal buyers who were waiting for a clearer macro signal start allocating. Downside scenarios feel less pressing, and volatility starts to move from crashing to trending. Ethereum benefits as well, particularly if lower rates boost risk appetite for more complex narratives like staking and DeFi. Altcoins, especially the higher beta names like Solana, and some of the headline layer 2 and AI plays can see exaggerated upside as traders reach for outperformance. The second scenario is the hold. In this one, the Fed looks at the incomplete data, the still elevated inflation prints, and the warnings from officials like Bostic and Collins, and decides that caution is the better move. No cut in December. Instead, they emphasize that they'll reassess in early 2026 once the data backlog clears and they have a better sense of where the real economy is heading. On the surface, that doesn't sound dramatic. After all, no cut just means rates stay where they are. But markets don't trade on levels. They trade on expectations. If a significant chunk of traders are positioned for a cut and don't get one, there's a decent chance you see an initial risk-off reaction. Yields might pop back up, stocks might wobble, and crypto, which has already had a brutal few weeks, could struggle to find its footing again. In that hold scenario, Bitcoin might not collapse, especially if the tone from Powell is balanced and he leaves the door open to cuts in the first half of next year. But it does mean that structurally, the big liquidity wave that a lot of bulls are betting on gets pushed further out. That tends to sap momentum. It encourages some ETF investors to sit on the sidelines a little longer. It keeps leverage in check. And it may extend the choppy, confusing trading environment that's dominated the last month instead of giving us a cleaner trend. The third scenario is the shock. Either a bigger than expected cut or a very hawkish tone even if they cut. The bigger cut is less likely given the internal division, but in a world where the data suddenly collapsed into disaster zone, you could imagine the Fed responding with a more aggressive move. That would probably send crypto flying higher in the short term, but it would also scream, something is seriously wrong about the underlying economy, which isn't necessarily bullish beyond the initial pop. The hawkish tone scenario, on the other hand, is more plausible. Here, the Fed might deliver the cut that markets expect, but pair it with messaging that emphasizes caution, inflation risk, and a willingness to pause again. That's where you can see risk assets whip around violently. A green candle on the headline, followed by a red one as people process the nuance. To really understand how this December crossroads feeds into crypto, we need to zoom in on two concepts: liquidity and narrative. Liquidity is the obvious one. When the Fed cuts, it lowers the reference cost of borrowing throughout the system. That filters into everything from margin financing to corporate bond yields to mortgage rates. For institutions, it changes the way they model risk and return. And because crypto doesn't have cash flows or dividends, it lives and dies on how attractive it is as a store of value or a speculative vehicle relative to other assets. When safe yields are high, crypto has to work much harder to justify its place in a portfolio. When those yields fall, the hurdle rate drops. Suddenly, the idea of owning Bitcoin alongside equities or using Ethereum and Solana to ride a new tech wave looks a lot more appealing. Next, narrative is the less obvious but equally powerful force. Every rate cut carries a story with it. Is this the Fed panicking about recession? Is this the Fed calmly engineering a soft landing? Is this the Fed bowing to political pressure, or acting independently in the face of noisy criticism? Each of those narratives has a different emotional impact, and crypto is incredibly sensitive to narrative. If traders believe the Fed is in control, easing deliberately and with confidence, that's bullish. It suggests a smoother macro backdrop where risk assets can rally without constant fear of policy whiplash. But if the story becomes, the Fed is cutting because things are breaking, then you get a different response. You might still see speculative pumps, but they'll be undercut by anxiety and a sense that you're dancing on a cliff edge. One of the big lessons from previous cycles is that crypto doesn't just react to what the Fed does. It reacts to how coherent the Fed sounds. During periods where Powell and the other officials deliver a clear, consistent message, markets may not like the decision, but they at least understand it. During periods where different Fed voices are pulling in opposite directions, contradicting one another in speeches and interviews, you get heightened volatility and mispriced risk. Right now, we're closer to the second scenario. You've got daily open to cuts, Bostic and Collins arguing for a pause, John Williams highlighting inequality and household strain, and Powell trying to hold the center. That tension will be dripping off every word in the December statement and press conference. For crypto holders, especially those thinking in months and years rather than days, the key question isn't, will Bitcoin go up on the day of the decision? It's, what kind of environment are we heading into for the next 12 to 24 months? If December's meeting confirms we're in a gradual, controlled easing cycle, with the Fed willing to support the economy without losing its grip on inflation, that's the kind of backdrop where crypto has historically done very well. It doesn't guarantee new all-time highs overnight, but it does provide a tailwind instead of a headwind. If, on the other hand, December delivers confusion, a muddled message, a split vote, an unclear plan, then we could easily stay stuck in a sideways choppy mess where every small macro release sends Bitcoin up 5% one day and down 7% the next. So, how do you think about positioning around this? The honest answer is that nobody knows exactly how the December 9th and 10th meeting will play out, not even the people sitting on the FOMC. Views inside the Fed are evolving with every new piece of data. But we can say a few things with some confidence. The first is that volatility around the decision is almost guaranteed. The second is that the decision will likely set the tone not just for the rest of the year, but for the first quarter of 2026. And the third is that, in previous cycles, some of the best long-term crypto opportunities have appeared in periods exactly like this, where macro uncertainty is high, where sentiment is bruised, but where the structural direction of policy is shifting from tight to loose. There's also a behavioral piece to this. Right now, a lot of people in crypto are tired. The correction we've just been through has drained energy, wiped out overconfident leverage, and scared away a lot of short-term speculators. That's painful, but it's also what clears the runway for the next phase. If December's meeting tilts things toward easier conditions, even gradually, you don't need everyone to suddenly turn bullish. You just need the marginal seller to disappear, and the marginal buyer to reappear. Slowly, quietly, patiently. If you're thinking long-term, the Fed Crossroads isn't just about green candle or red candle next week. It's about whether the macro tide that's been pressing against crypto for the last couple of years is finally starting to turn, or whether we're stuck in the chop for a bit longer. A cut in December, paired with a measured, confident message, would suggest that the tide is starting to move. A hold with a cautious, perhaps slightly hawkish tone would suggest we're still in the transition zone, waiting for clearer skies. Either way, this is a moment to pay attention to, not just for traders staring at charts, but for anyone who cares about where this whole space is heading over the next cycle. Crypto is no longer off to the side of the financial system. It's plugged in. When the Fed moves, we feel it. When the Fed hesitates, we feel that too. We'll wrap it there. If you found this deep dive useful, make sure you're following the show so you don't miss the next one. Don't forget the Christmas giveaway. Once we hit 200 ratings, 2 listeners will each receive 50 XRP. If you've already given us a rating, just comment "done" so we know to count you in. It takes a few seconds and genuinely helps the show more than you'd think. As always, drop your thoughts in the comments, let us know how you're feeling heading into the Fed's December meeting, hit follow, and we will see you at the top.